I promised a video on Wayfair, and here it is. My gosh, this bad boy was up 24% nearly today. Just got off work, so obviously I didn't notice this until just now. Holy crap. And this is after reporting in earnings this morning, pre-market. That is crazy. Now, I anticipated a good earnings report, so I'm curious how good this earnings report was if this thing shot up nearly 24%. Well, if you look, first off, gosh dang. Non-GAAP EPS of negative $2.30. Beat by 31 cents, though. GAAP EPS of negative $3.04. Beat by 27 cents. Revenue of $2.33 billion, up 20.1% year over year. Beat by 20 million. Oh, it originally was down pre-market, obviously, but gosh. So Wayfair is a company I wasn't too experienced with, obviously. I know what they do, but I didn't know the financials of it. This is disgusting. I'm just going to tell you right now, you know how much I hate unprofitability. That is a disgusting line right there. Negative $3 per share. That is a disgusting line. I want to see what that equates to, but we got a lot to cover with Wayfair. So Wayfair shoots higher in early trading, copying quarter one expectations of revenue growth of 20%. Average or active customers in direct retail business channel rose 28.6% at 21.1 million. Orders per customer was 1.86 for the quarter versus 1.85 a year ago. And LTM revenue per active customer rose 1.6%. So the company generated adjusted EBITDA of negative 127 million versus negative 102 million last year. Oh my gosh. The guidance range was 171 million to 230 million though. Oh gosh. They're rising the losses. All things considered. Uber lost $4 billion in a quarter, so it's not the end of the world, but gosh, that's just ugly. It's ugly to see that rise, and gosh, I hate it. Wayfair says that quarter to date revenue is up 90% as momentum has stayed strong in quarter two. As expected, I 100% expected this to stay strong. Obviously, online retail seeks to benefit a lot from this, and I knew Wayfair would be one of the ones that actually benefits one of the most out of this. Not a shocker. It's holding off on issuing formal guidance due to the uncertainty of how long the current trend will hold, which makes sense. Again, it could just decline in a matter of a week. People stop using Wayfair. You never know, honestly. Let's see. So Shopify and Etsy both were up as well. So a day before their earnings, because people are excited about what's going to happen. I think Shopify is going to absolutely smash their earnings target, but Etsy should do fine as well. But that's crazy. You see this helping other companies do well. Other online retailers like Stitch Fix, which I'm a huge fan of. Chewy as well. Overstock.com, Carvana, But I like Chewy and I like Stitch Fix. Chewy does not make money either, so that's a scary one too. So Wayfair is holding up on its post-earnings gain after posting strong quarter one numbers. Definitely nice. Quarter to date, they saw 90%, translating to over 80 million in added revenue year over year. This momentum is widespread across all categories. Very nice to say from Mr. Michael Fleischer. While we do not know how long these trends will persist, we believe the period has certainly and permanently accelerated e-commerce adoption in our category. Very nice. So now we'll get into this earnings presentation, if you don't mind. Look at this lovely slide to start it off. It's just beautiful. It's just absolutely beautiful. So, a brief history. They were founded as CSN stores previously. In 2011, they became Wayfair. They rebranded. They exceeded $600 million in net revenue for the first year. Then they IPO'd in 2014. In 2015, Cascade, the logistics network, tested and launched Wayfair .ca for their Canada launch in 2016. New initiatives staffed up and supplied value-added services tested and launched in 2018, and in 2019 they had over $9 billion in net revenue, with an annual growth of 35%. Pretty massive growth there. So, they have approximately $600 billion total addressable market, rapidly moving from brick and mortar to online. That's what they're saying the whole retail business is as a whole. But again, not all retail is going to brick and or online. Not all of it is. It's just not how it is. If you think it is, you've lost your mind. They're utilizing in-house software development capability to build and leverage proprietary technology. They're partnering with fragmented and largely unbranded supplier bases of over 12,000 suppliers. So pretty exciting. They're solving unique challenges of the category by building business purpose-built for home. Makes sense. Highly recognized brand in North America. Obviously, repeat customers are big for them. They're investing in specialized logistics network, international markets, and existing teams to continue outsized share taking, balancing a return to profitability with aggressive investing in for the future. I don't know about profitability. It looks bad, fellas. They have an attractive financial profile. Debatable. Proven unit economics and inventory light business model. Co-founders are largest shareholders. So let's take a look at what we got going on here. So here are some of their estimates here. Okay, a little bit absurd overall, but by 2029, you see a majority of their business, as they expect, not a majority, but a good portion of the business is going to increase in terms of the online perspective. By 2023, they expect online and offline to grow. Then by 2029, you see a decrease in online or in offline and more online sales. Interesting. So estimate online penetration. They're estimating 14% of the home goods segment. They're in there. 30% of apparel, 43% in consumer electronics. They're pretty big on. Tailwinds for millennials beginning to enter. So the customer demographic, median household income is $75,000, and approximately 40% of sales are from customers aged 31 to 50. So millennials are their big generation. Obviously, these people are very tech focused. Makes sense. So home category should be the most anticipated online growth, all things considered. It's pretty interesting. We're taking significant share as dollars as they shift online. Online breakdown. So pretty cool. Yeah, they were a good portion. 38% of the home online growth breakdown. That's just pretty cool. So interesting stuff. They outlined some problems, and obviously the recession has to go into that. They help shoppers visualize their purchase through technology, meaning that they're able to have an augmented reality type thing where you can see a 3D view of the thing in a room. So this is going to give you a model of what exactly you would get if it's a furniture item. So you can see what it would look like instead of just going off pictures, which is lovely. They'll give you ideas for other furniture to add as well. You can search with a photo of something, and they can give you that. I mean, this is a very future-proof company, right? They're investing a lot in technology, which makes sense. They're a very tech-focused company. They need to do that. So, nothing too absurd there. I mean, it's pretty cool, the things this company's doing. Obviously, very nice brands that they have. 11 times higher visits per SKU than non-flagship SKU. So this is going to be just obviously items. Definitely exciting stuff as far as that's concerned. I clicked out of it, so don't be too unhappy with me there as we skip through and get back to where we were. So their fourth step obviously is all about customer service and delivery. In-house customer service team of over 3,400 people in the U.S. And Europe. Pretty exciting. And obviously they mentioned some 5-star reviews here. Customer service is the greatest ever. They took one of the 500 reviews they got that was positive and said, let's post this one. Wayfair is the central brand in the business, the driver of the business. 87% U.S. aided brand awareness since Wayfair.com launched 2011. People know the brand, obviously. Everyone knows the brand. It's the number one place for consumers to think shop from their home online, apparently. That's what they say, at least. I don't know about that one, but so Wayfair covers a lot of different areas. So obviously, they've got Perigold, Jocelyn Main, Birch Lane, and All Modern, which are more of like they're the higher end market, where Wayfair kind of covers every segment there. They have everything going on for them, but they also have their own unique brands as well. So the 4 home sites have unique identity. All Modern is really for modern furniture. Jocelyn Main, obviously stylish designs. Birch Lane, classic home, comfortable cost, and Perigold is the widest ever selection of luxury home furnishing. These are the rich people furnitures. Makes sense. So the base customer loyalty is growing in their respective. 53% of Wayfair.com orders came from customers who had made 3 or more lifetime purchases. In 2015, the figure was only 30%. So, yes, again, they're building brand loyalty because people like the service. They do like the service. There's no doubt about it. So their focus, obviously, is brand integration. They're partnering with Discovery/Scripps and other networks to reach the target customers through TV ads. Think about Property Brothers. How many of your parents watch Property Brothers? I know mine certainly obviously watch HGTV, stuff like that. Wayfair certainly has commercials on there. There's no doubt about it. They do it through direct to mail. Kind of an antiquated service, but what can I say? Major promotional campaigns you see digitally online. Online paid advertisements, as well as just organic engagement, people searching through like social media and just people posting for them, really getting them that excitement. We view suppliers as partners and create value-added services to propel businesses with Wayfair. They want suppliers to, really team up with them. They're not going to be the ones chasing through logistics, services, and events, and technology. So their priorities for long-term, obviously scaling logistics capacities and warehousing. You want that to expand rapidly, obviously, so you need to worry about how you're going to get more merchandise in your warehouse. International is a big thing for them. They want to spread internationally, and they want to penetrate further. I did not say that. So they want more customers. Let's just say that. As far as logistics are concerned, obviously, again, Don't tell anyone. Don't tell anyone what I just did there. I clicked out of it again, and it makes me upset. So logistics can be big. As you see, these are Castlegate facilities located here, and a lot of them travel by boat. That's right. Most of their stuff is traveling by boat. So nothing super exciting out of these slides. All things considered, we talk about international expansion. For the most part, it's all about Canada right now. They're really working on expanding over in the UK as well. So, key performance indicators, as you see, and I don't know why I said that. So, definitely massive growth you see going on here. So, obviously you can see from this chart. Come on now. Look at this absolute massive sales growth from U.S. net revenue and international revenue combined. International is just starting, and U.S. it just keeps growing, and that's just through quarter one. They've already beat what they had in 2019 as a whole. Pretty massive. So definitely strong customer acquisitions. So net revenue per active customer, you see consistently increasing, and active customers keeps increasing. Pretty nice. New and repeat orders. Percentage of orders from repeat customers just keeps going up as well. They're talking upwards of nearly 70% right now. Pretty big. Their long-term target, as you see, obviously they want to keep growing net revenues 100%, but gross margin, they're aiming for 25 to 27. Right now they're right in that range almost. Customer service and merchant fees of around 4%. Advertising, they want less advertising in the future. Obviously, right now they're focusing on getting their brand out there, and that's where you see a lot of expense on advertising. It's what a lot of companies do. There's a lot of money to spend to get your name out there first. From selling, technology, general administration, they're expecting 5 to 7% as well. And again, we talk about the extra expenses that they have to go through right now. It just makes sense. This is part of a flourishing company. When you're growing, a lot of them have to face that, unfortunately. So, as far as inventory is concerned, net revenue is just outweighing it big time. You get a lot of revenue here. Nothing crazy. Nothing crazy. And finally, we talk about the appendix here. What I care about, that net loss line is rough. But it was worse. That's right. I can't say it was worse. I'm sorry. I lied to you. It could be worse. Right? Could be. I don't know. Debatable. Quarter over quarter, you see $80 million more lost in this company. That's an ugly line, right? It just keeps increasing. It just keeps increasing, that net loss line. And it looks like this year it's only going to keep increasing. Where's that sustainable? You know what I mean? How is that a sustainable thing? It's hard to say. So we're going to look, obviously, finally, at just the 10Q, these financials, and we'll look at the balance sheet to see how they're possibly surviving when they're spending all of this cash. Right, if they're losing all of this money, where's this going? So current assets of $624 million. I believe this is in million or in thousands. Yeah, in thousands. So $624 million right now dollars. Total current assets of $1.27 billion. Total assets of $2.7 billion. All right, this is one that I need you to avert your eyes. Okay? Total liabilities on this company, $3.9 billion. Guys, the company is already overweight in terms of debt and liabilities. Long-term debt of $1.5 billion on this company. Son of a gun. That number just keeps rising. It's not something you like to see. It scares me with this company. I wouldn't touch this company with a 10-foot pole, unfortunately, just because of the fact that I don't know that it's an unsustainable business model when you talk about how much money they're losing. It just is. It's just, gosh. I don't think it's trading at just a crazy market cap, but this is a company losing money hand over fist. Nearly $1 billion last year. This year they will lose over $1 billion. I get their growth is planned for, more digital, but shoot. They're probably going to lose EPS when we talk about digital for them. So I just don't like what's going on here with this company. I don't think I can touch it. I don't think I can touch it with a 10-foot pole. I'm sorry. Year to date, this stock's up 78%. It's just, I don't think it deserves that. I don't think it deserves that, in all honesty. We're talking about a rise of, 500% from their lows. If you bought this thing down in the 20s, you are just a genius, man. You're a genius. You could have gotten this thing for $21 and now up to $165. Congrats if you did that, but I would not touch this company with a 10-foot pole at this valuation. I'll just tell you that right now.